Hello everyone, let's talk about your money. Specifically, let's talk about making your money work for you. This is the heart of building real, lasting wealth. You have likely heard the words trading, investing used often. They are different. I am here to tell you, they do not. Understanding this difference is the absolute first step before you put one single dollar into the market. Both are powerful tools for growing your finances, but they are used in very different ways. So listen up. Investing is about playing the long game. It is about ownership. When you invest, you are buying a small piece of a company. You are planting a financial tree. You water it, you give it sunlight, and you have the patience to watch it grow. This is not about getting rich quick. It is about a slow, steady, and disciplined approach to wealth creation. Let's get even clearer on the differences between these two approaches. The biggest difference is time. An investor thinks in terms of years. Their holding period is long. They buy assets and plan to hold them through the market's natural cycles of ups and downs. They believe a strong company will increase in value, benefiting from profits and dividends. They are not panicked by a bad day. They have the discipline to wait. Time and compounding are their allies. In contrast, a trader thinks in terms of minutes, hours, days, or weeks. They buy and sell to profit from short-term price movements, often using technical indicators rather than company fundamentals. Investors perform fundamental analysis, financials, management, intrinsic value. Traders use technical analysis, price patterns, volume, indicators. For a trader, market psychology matters more than company financials. Your personality, goals, and risk tolerance will determine which path or what mix is right for you. But you cannot make that choice until you are educated. That is what we are here to do. One is a marathon. The other is a series of sprints. Know your aim and pick tools accordingly. Now, you cannot just walk onto the stock market and start buying things. You need the right tools. To access your money at the bank, you need a bank account. To participate in the stock market, you need two special accounts: Demat account, trading account. These two accounts work together but serve very different purposes. You must have both to trade or invest online. Demat equals dematerialization, turning physical share certificates into electronic form. It holds what you own. It does not buy or sell. The trading account is your gateway to the stock market. You use it to place buy and sell orders. It links your bank to your Demat. Money flows from your bank account to your trading account to the stock exchange. Purchased shares are delivered to your Demat for safekeeping. Place an order through your trading account. Money moves from bank. After purchase, shares are credited to your Demat. When you sell, the reverse happens. Shares move from Demat to the exchange, trade executes, money returns to your bank. You need both accounts to play the game. Flowchart summary: bank account, trading account, stock exchange, Demat account. Once your accounts are set up, you need to know how to communicate your intentions to the market. You do this by placing an order. The three most fundamental orders you must know are market order, limit order, stop-loss order. Market order. A market order buys or sells immediately at the best current price. It prioritizes speed over price. I want this stock right now. I'm willing to pay the current market price. But price isn't guaranteed. You might experience slippage, paying slightly more or less than the last price. Limit order. It gives you control over price. It's an instruction to buy or sell at a specific price or better. Example: stock at $50, you place a buy limit at $49. It executes only if price hits $49 or lower. Advantage: control the price. Disadvantage: it may never fill. Stop-loss order. Defensive order to limit potential loss. It instructs to sell if price falls to a set level. Example: buy at $50, stop-loss at $45. If price hits $45, the stop-loss triggers and becomes a market sell. Use stop-losses to manage risk and protect capital. It's your financial seatbelt. Required for serious trading. Recap: market = immediate execution. Limit = price control. Stop-loss = risk control. Master these three commands for greater control. Alright, once you have mastered the basics, you may hear people talking about more advanced topics. I want you to be aware of them, but I also want you to be very, very careful. Derivatives are financial instruments whose value is derived from an underlying asset, like a stock or a commodity. The two most common types are futures and options. Futures, a contract to buy or sell an asset at a predetermined price on a specific future date. It is binding. Example, a farmer locks in a price for wheat to be delivered in 3 months to protect against price drops. In markets, traders use futures to speculate without owning the underlying. Leverage can magnify profits and devastating losses. Options give the buyer the right but not the obligation to buy or sell at a strike price on or before expiration. Two main types: call, right to buy, and put, right to sell. Unlike futures, you are not obligated to execute. Your loss as a buyer is limited to the premium paid. You can let options expire. Traders use derivatives for speculation. Large profit from small investment. Investors use them for hedging, protecting a portfolio, for example, buying puts as insurance. These are complex tools and are not for beginners. They involve risk and leverage. Do not touch these until you are experienced. They can wipe you out. For 99% of you, focus on buying great companies and holding them long term. Leave futures and options to seasoned professionals until you have years of experience. Your financial security depends on it.